So my name is John Moore, and I'm a member of the School of Economics here at the university, and I'm also the director of MacCaLM, which is co-hosting tonight's talk. Jane Frances Kelly will be doing the introduction of our speaker tonight, so let me not trespass on that ground, but I would like to say something about MacCaLM. It sounds, well, we wanted an acronym that sounded like a satisfyingly smooth, expensive malt whiskey. But actually, it's short for Macroeconomics, Credit, and Labor Markets. And our thinking was, we're not alone in thinking this, is that the 2007-8-9 crisis, which is still with us, of course, revealed macroeconomics to be in somewhat worse shape, perhaps, than we'd hoped. And that collectively, as a profession, maybe we should go back to the roots and rethink macroeconomics, particularly macroeconomic theory, from the bottom up. And with particular emphasis on the labor market, which is, of course, where unemployment rears its ugly head, and in financial markets, which is the epicenter of the recent crisis, and hence the name MacCaLM. We approached the British government, who were kind enough to give us £6 million, actually, spread over 5 years, and tonight's event is one of the fruits of that extremely generous sponsorship from the Economic and Social Research Council of the UK. So that's MacCaLM, and at this point I'd like to hand over to Jane Frances, who will effectively, I believe, turn this now into a David Hume event. So thank you very much indeed.
I wish I knew a magic spell for turning things into a David Hume event. I'd love to have gone to an actual David Hume event. Good evening and welcome. I'm Jane Frances Kelly. I'm the director of the David Hume Institute. For those of you who haven't come across us, we're an independent, non-aligned, evidence-based policy institute based here in Edinburgh, focusing on the economy and education issues in particular in Scotland. And we host a series of events with speakers from a series of expertises, all sides of the political spectrum, from both around Britain and internationally as well. And we're also aiming to carry out research, particularly on the Scottish economy, which we find that there's very little independent research actually happens on the Scottish economy, which is amazing. I couldn't resist that with a room full of economists. So, but before I introduce our speaker this evening, I'll just briefly mention our next 3 events for which you can register on the David Hume Institute website. So a week today, Paul Skute Christofferson will speak at Brodie's about the 1992 Danish Maastricht Treaty referendum, when the Danes famously voted no. Paul is the former Danish permanent representative to the European Commission, and he'll speak about the renegotiations that then took place, what the connection to Edinburgh is, and what we might still learn from the experience for Brexit. On the 13th of November, Nick Macpherson, former Permanent Secretary to the UK Treasury, will speak about economic policy making in a UK outside the EU, and that will be at the Royal Society for Edinburgh. And on the 21st of November, Michael Keating and Richard Wynne-Jones will compare Scottish and Welsh perspectives on Brexit. That seminar will take place at a new venue for us at Codebase in Castle Terrace. Codebase is Britain's largest startup indicator, with over 100 technology companies on site and, as you would expect, particularly good coffee. It's a place where you can feel the momentum of tomorrow's economy being built, and we're delighted to be holding a David Hume Institute seminar there. Tonight, though, in partnership with MacCaLM, that's a fantastic pronunciation, by the way, at the University of Edinburgh, we're very fortunate to be welcoming Professor Christina Romer. Christina was chair of President Obama's Council of Economic Advisors from January 2009 to September 2010. She then returned to be Garth B. Wilson Professor of Economics at the University of California at Berkeley. She's a fellow of the American Academy of Arts and Sciences, has received a Guggenheim Memorial Foundation Fellowship and an Alfred P. Sloan Foundation Fellowship. and she is also a recipient of several distinguished teaching awards at Berkeley, and I particularly wanted to mention that because anyone who has ever been a student appreciates inspired teaching, not just being an academic. Christina, you will have noticed in your time in Scotland so far that we're understandably preoccupied with Brexit. A couple of weeks ago, the audience at the first seminar in the David Hume Institute Autumn Series heard Fabian Zulig remark that in his view, the current most likely scenario for Brexit involves a catastrophic economic outcome for the UK. And the audio is on the DHI website for anyone who wasn't there. So in that context, tonight's lecture could not be more timely. And so now I'm going to stop talking so that Christina can start. Please join me in welcoming Christina Romer.
Well, thank you. It is such a pleasure to be here this evening. More generally, it has been just an incredible delight to spend our sabbatical at the University of Edinburgh this fall. Our colleagues in the School of Economics are not just superb scholars, but they're also incredibly nice people who've made us feel very welcome. And on top of that, we get to go on Scottish adventures every weekend. And this past weekend, we went on a drive up to the North Coast, and I have to tell you, it combined 3 of our very favorite things. 1, beautiful highland scenery. 2, one-lane roads with passing places. And 3, lots of sheep. So life does not get any better than that. Now, however, if you look at the topic for my talk this evening, you're going to see that it's on a much less cheerful topic, and that is the aftermath of financial crises. And to give you a sense of the motivation, I think following the 2008 financial crisis, a somewhat fatalistic narrative took hold. As countries throughout the world sank into deep depression, both economists and pundits seemed to adopt the view that this was inevitable, that the aftermath of financial crises is just always awful. And by far the most influential work in this area is the book by Carmen Reinhart and Ken Rogoff, titled This Time is Different. And Reinhart and Rogoff's title is meant to be ironic. This time is different is what policymakers and politicians always say just as their economies embark on the speculative bubble destined to lead to the financial crisis. And Reinhart and Rogoff emphasize the commonalities in the aftermath of crises. Their overarching message is that financial crises do severe damage to an economy. And drawing on a wide sample of crises across history and across countries, they show that on average, output falls substantially and unemployment rises following crises. And from this evidence, it's easy to kind of slip into the mindset that the recession following a financial crisis is just something to be accepted and ridden out, sort of like a very bad stomach virus for which there's no treatment. You just suffer for a while, perhaps a long while, and wait for it to pass. But as someone who has studied the American Great Depression closely, I've always been somewhat suspicious of this view. You know, the Depression in the US is often cited as the quintessential example of a financial crisis leading to a horrific downturn. But that's really much too simplistic, right? The Great Depression in the US started in late 1929, almost a full year before the first wave of troubles in the banking sector. Moreover, the financial crisis back in the 1930s was not a single event, but in fact a series of banking panics, each interspersed with times of relative calm. And Friedman and Schwartz, in their classic study, A Monetary History of the United States, show that there were 4 distinct waves of banking panics in the early 1930s. And actually, I have my first picture is just showing you the dates of their panics. The first was in October of 1930, then followed by panics in the spring of 1931, again in the fall of 1931, after Britain went off the gold standard, and finally in January of 1933, just before Franklin Roosevelt's inauguration. And what's striking is, in fact, the variation in outcomes after the different waves of panics in the Depression. And so what this picture shows, I've now added in a picture of industrial production to give you a sense of what was going on in the economy, and we still have the lines for the dates of the panics. And what you see is after the first 3 waves of panics, output did indeed plummet. But after that 4th wave, which was arguably the worst, output quickly recovered. Industrial production actually surged more than 50% just between March and July of 1933. So what I think the experience of the Depression suggests is that the aftermath of financial crises is in fact highly variable. The outcomes can indeed be wretched, but they can also be remarkably benign. Well, in some recent research, David Romer and I examine the aftermath of financial crises more systematically. And actually, in a paper that David presented earlier today, we derive a new scaled measure of financial distress for 24 advanced economies in the post-World War II period. We look at both the typical aftermath of acute financial distress and the variation in outcomes across episodes. And by far the most important finding of the paper is that the aftermaths of crises are not all the same. There is, in fact, wide variation in outcomes, even in a sample of countries that are very similar in their institutions and degree of development. Or to put a completely non-ironic twist on Reinhardt and Rogoff's title, sometimes really are different. So in my lecture this evening, what I want to describe is some new research we've been doing on what accounts for this variation. And this work is also joint with David. And the experience of the Great Depression is again relevant. Why is it that the first 3 waves of panics were followed by crushing real decline, while the 4th was followed by rapid recovery? Well, I'd suggest that macroeconomic policy played an important role. Following the first 3 waves of panics, the Federal Reserve stood idly by and let banks fail. The result was a drastic decline in the money supply as people pulled deposits out of the banking system, and a complete collapse in financial intermediation as bank failures destroyed borrower-lender relationships. On the fiscal side, policymakers responded to the early waves of panic in the Depression not with fiscal stimulus, but with contractionary policy. For example, alarmed by rising budget deficits caused by very high unemployment, President Herbert Hoover championed one of the largest peacetime tax increases in US history in 1932, smack at the worst part of the Great Depression. And the result of these monetary and fiscal policy actions, or we could call them mistakes, was that the banking panics kept recurring and the real economy was devastated. But the policy response after that 4th wave of panics was completely different. Right? Franklin Roosevelt declared in his inaugural address that he would fight the Depression with the same vigor he would an invading foe. He immediately took drastic steps like a nationwide bank holiday to stabilize the financial system. The US devalued its currency and allowed gold inflows to swell the money supply. And Roosevelt embarked on an ambitious program of public employment and fiscal expansion to put people back to work. And the evidence suggests that these policies were effective. Expectations turned around rapidly, real interest rates fell dramatically, and both investment and consumption rose quickly. And the result was that stunning rebound in output in mid-1933. In the new work that I'm going to discuss this evening, we look at the role of macroeconomic policy in accounting for the variation in aftermath that we observe following post-war financial crises. To what degree are better outcomes associated with a more aggressive policy response? And we're going to focus most closely on the role of macroeconomic policy space. By that I mean sort of what's the room that policymakers have to maneuver? For example, do countries begin a financial crisis with low debt and hence room to use fiscal policy aggressively? Do they suffer less negative aftermaths? Similarly, do countries whose central banks are not at the zero lower bound on interest rates when a crisis starts and hence are able to reduce interest rates, do they fare better? We also are going to look at some of the mechanisms by which policy space might matter. Do countries with fiscal and monetary space actually use policy more? Or are crises themselves less severe and protracted in countries with more policy space? And we think the answers to these questions are fundamentally important for both economists and policymakers. They go directly to the heart of how we think modern economies behave and how crises affect them, and of how policymakers should conduct monetary and fiscal policy, both in normal times and after severe financial distress. All right, so that's where we're headed. And the place to begin the discussion is with evidence on that the aftermaths of crises really do vary. And to that, I need to at least describe a little bit our earlier study. And the centerpiece of that research was the derivation of a new scaled measure of financial distress for 24 advanced economies. And like most of the previous literature, we rely on qualitative information about financial conditions rather than quantitative indicators. That is, we're going to focus on narrative descriptions of the health of the financial system. However, we're going to approach the use of qualitative information sort of as scientifically as possible. We start with a careful definition of what we mean by financial distress. We're going to look for times when the cost of credit intermediation rose, say because of a rise in the perceived riskiness of borrowers or a widespread loss of confidence in financial institutions. We're also going to use a single real-time narrative source to deduce this information for all 24 of our countries. In particular, we read the OECD Economic Outlook, which is a big semi-annual report summarizing economic and financial conditions in OECD countries, which are typically large, modern, advanced economies, hence our focus on advanced countries. And from the narrative descriptions, we attempt to scale the degree of financial distress in each country in every half year between 1967 and 2012. That is, rather than just say that a country had a crisis in some year or it didn't, we're going to try to account for the differences in the severity of the financial distress and for how financial distress evolves in the various countries. And we're going to measure the severity just on a scale from 0 to 15. All right, so what comes out? Here's our new measure of financial distress for the 24 countries in our sample. And you see a couple of things from this picture. One thing that you can't help but notice is that there was almost no financial distress in any country before the late 1980s. And actually, I think this is consistent with the view that strong regulation and conservative practices resulted in tremendous financial stability in the early post-World War II period. Then when we get to the 1990s, there are some notable crises, particularly the Nordic countries and Japan. And in fact, Japan, which is the black line, stands out because it experienced financial distress for nearly 15 years, some of it obviously quite extreme. And then finally, you can't help miss the 2008 global financial crisis. Literally every country in our sample experienced some financial distress in this period. But something else that you can see from this jumble of lines is substantial variation in distress across countries, even within this one episode. For example, the financial distress was extreme, but fairly short-lived in the US. It was very mild in Australia and Japan, and it was moderate, but very persistent in Italy and Spain. Now, similar to the focus of the previous literature, one of the things that we investigate in that earlier paper is what's the typical aftermath of a financial crisis? And to do this, we run some very straightforward panel regressions. We have data on real GDP and financial distress for 24 countries. We're going to focus on the period just since 1980 because most of the policy indicators that are central to our later analysis aren't available until 1980. And what we're going to do is run a sequence of regressions of real GDP at various half years after time t on financial distress at t. And then the sequence of coefficients on the financial distress at different horizons provides an estimate of the impulse response function. That is, they show how output behaves following an impulse to our measure of financial distress. And we're going to focus on the reaction reaction to a significant impulse in distress, a 7 on our scale. And a 7 roughly corresponds to the start of the moderate crisis range and is sort of comparable to what other crisis chronologies would call a systemic crisis. Okay, so here's the picture of the response of real GDP to a substantial realization of distress, or the behavior of GDP following a crisis. And this shows what happens on average to output following a financial crisis. And what you can see is that the result is negative and quite persistent. On average, output falls following financial crises and remains low. At the same time, the typical decline is decidedly moderate in size. A financial crisis is associated with a persistent decline in real GDP of about 6%. So that's unquestionably bad, but perhaps not all the way to wretched. Now, as I mentioned in the beginning, we feel that the more important finding is not the moderate size of the average aftermath of crises, but rather that there's a great deal of variation. And one way that we show this variation is just with a very simple forecasting exercise. So in our sample, there are 19 episodes when financial distress in some country hit a 7 or higher, a crisis on our scale. So what we do is we're just going to run a simple regression of how GDP typically responds to lagged GDP. And then for each crisis episode, we construct just a simple univariate forecast. And we use actual GDP only up through a year before distress hit 7. And then we're going to subtract that forecast from what actually happened to GDP to create the forecast error. And if crises have negative effects, as this impulse response function suggests, right, we'd expect those forecast errors on average to be negative, right? And also if the variation in aftermaths would show up as a wide range of forecast errors. They'd have different sizes, right? And that's exactly what we observed, right? So this slide's going to show you that in 9 of the 19 episodes of high financial distress, the univariate forecast errors are actually small or even positive, right? What that means is that following a crisis, the behavior of output in these cases is only a little worse or possibly even better than you would have predicted just knowing lagged output. An example is Norway. That's the red line that you see there up at the top. Following its crisis back in 1991, Norwegian GDP fell slightly for a year, but then grew rapidly, right? And what results are these positive forecast errors, which indicate that GDP actually grew faster after Norway's crisis than the history of GDP would lead one to expect. All right, now this slide shows 4 cases out of the 19 where the forecast errors are sort of moderately negative, right? That is, output following a crisis is moderately below what you would have predicted based just on lagged output. Example here is Sweden. That's the dark blue line. Output certainly fell relative to a univariate forecast, but the error is only about 3%. And then finally, this slide shows you the problem children, right? So these are the cases where the univariate forecast errors following a crisis are severely negative. And the episodes in this category are Japan, the Southern European countries after 2008, and Iceland after 2008. And in each case, output following the crisis was dramatically lower than the past history of GDP would lead one to expect. So I hope what this analysis drives home is the point that the aftermaths of financial crises are not all the same. Some truly are wretched, but some are remarkably mild. And this suggests if we can figure out why some times are so much better than others, we could prevent a lot of suffering the next time a country experiences acute financial distress. Okay, so as I suggested at the beginning, the possible explanation that I want to focus on today is the contribution of macroeconomic policy, by which I mean sort of conventional monetary and fiscal policy. And the first and most important thing that we're going to look at in this realm is the role of macroeconomic policy space in accounting for the variation in the aftermaths of financial crises. And as I said, what I mean by that is just sort of what's the room that policymakers have to use their policy tools. For example, if policy interest rates are already close to zero when a crisis starts, the central bank's going to be severely limited in its ability to use conventional monetary policy to deal with the effects of a crisis. Similarly, if a country begins a crisis with a high debt to GDP ratio, policymakers are less likely to be able to bail out the financial system or to use fiscal stimulus to cushion the impact of the crisis. All right, so an obvious question, why look at whether the aftermaths of crises vary with macro policy space rather than just with the macro policy response? Well, the answer is that the results are much less likely to be driven by reverse causation. So think about the following, right? We'd expect a country facing a more severe recession following a crisis to use policy more aggressively. As a result, one might well find that crises accompanied by a more aggressive policy response have worse outcomes, but causation would almost surely run from the outcomes to the policy, not the other way around. Policy space before the crisis, on the other hand, is more likely to be driven by fundamentals. So is a country typically fiscally prudent, like Germany, or fiscally profligate, like Greece? Does a country typically have very low inflation, so nominal interest rates are typically low, like Japan in the 1990s and after, or moderate inflation, so that nominal rates typically hover well above the zero lower bound? At the same time, we expect policy space to be correlated with the policy response. Indeed, I'll show you some direct evidence of this in a bit. So looking at how the aftermaths of crises vary with policy space can capture the likely contribution of policy while avoiding at least some of the endogeneity issues. Okay, so let me start with the role of monetary policy space. Right? And there are various ways that you could imagine measuring monetary policy space. The simplest one, and the one that we use as our baseline, is just a dummy variable for whether the policy interest rate in the half year before financial distress is above 1.25%. Right? Now, the policy interest rate is just the interest rate that the central bank controls, and 1.25% seems to correspond roughly to the level of policy rates at which central banks feel constrained. Now, we're going to consider a range of other measures of monetary space. For example, we try a version that treats being in the euro area as a constraint on monetary policy. Fortunately, the results do not appear to be very sensitive to the measure used, so I'm just going to focus on the very simple measure. Now, I already described sort of the basic regression framework that we use to think, say, about the average aftermath of a financial crisis, where we regress output at various half years after time t on financial distress at t. Those coefficients are an estimate of the impulse response. Now what we want to do is allow for the possibility that the aftermaths of crises depend on whether a country has monetary policy space. And to do this, we're just going to include an interaction term in this regression. And the interaction terms between financial distress and prior policy space. And if that estimated interaction effect is positive, right, it means that output declines less or does better after a crisis if there is policy space. All right, so what do we find? Well, first, that interaction effect is indeed positive and highly statistically significant. So countries do better following a crisis if they face financial distress with interest rates above the zero lower bound. And this graph shows you just how much better, right? So it's going to show you the response of GDP to a realization or an impulse in our financial distress measure of 7, so a moderate crisis, when a country has monetary policy space and when it does not. And what you can see is that negative response of GDP to a financial crisis is dramatically larger when a country doesn't have monetary policy space. The peak decline in output following a moderate crisis is almost 10% when there isn't monetary space and just 3% when there is. And an example that I think illustrates this interaction well is Japan following its severe financial distress in the late 1990s. So the history of Japan is that before their acute financial crisis in 1970, they'd been struggling with slow growth and low inflation following the bubble and bust of real estate prices around 1990. And so when financial distress became acute in 1997, interest rates were already close to zero, and so monetary policymakers really didn't have room to cut rates further. And actually, we can do the same kind of forecasting exercise that I showed you before, but now I want to compare two forecast errors. One is basically the same as before, right? So a forecast error coming from a forecast based primarily just on lagged output. And I want to compare that to a forecast error where now, in making the forecast, we're going to include this interaction with prior monetary policy space. And here's what comes out of it. So the blue line shows the forecast error when you don't account for the interaction effect, and the red is when you do. And what you can see is almost all of that big negative forecast error disappears when you take into account the fact that there's an interaction effect between the aftermath of crises and monetary policy space, and Japan didn't have any monetary policy space in this episode. All right, so that's the monetary side. Let me turn now to the interaction between the aftermath of crises and fiscal policy space. And by fiscal policy, we just mean policies having to do with the government budget. And so a natural, and what we're going to take as our baseline measure of fiscal policy space, is just the ratio of gross government debt to GDP in the calendar year before financial distress. And just as a technical aside, just because you see it here, we multiply it by -1, just so that it has the same sign convention as our measures of monetary policy space. A bigger number corresponds to more space. And the basic idea is that a country with a lower than average debt to GDP ratio is more likely to be able to use fiscal policy in response to a crisis than a country that starts the crisis with a high debt to GDP ratio. Now, as with monetary policy, we're going to consider a wide range of alternative measures of space. So, for example, we investigate whether the debt and deficit rules of the European Union Stability and Growth Pact act as a constraint on fiscal policy. And again, the variants yield very similar results, so I'm just going to show you the baseline. And armed with this measure of fiscal space, we can test whether the output consequences of financial distress depend on a country's ability to use fiscal policy. And to do this, we're just going to run the same kind of interaction regressions that I described before, but now we're going to use an interaction between financial distress and prior fiscal space. And the key result is that the coefficient on the fiscal space interaction term is again positive and extremely significant. So the aftermath of a crisis is better when there is more fiscal space. And to visualize the difference, I'm going to show you a graph again where we're going to look at two cases. And one we're going to define as being with fiscal policy space, and that's just going to be corresponding to a relatively low debt to GDP ratio, and without a relatively high, or more specifically, a high debt to GDP ratio we're just going to define as one standard deviation above the sample average. What you're supposed to see is that fiscal space appears to matter greatly, that the fall in GDP following a financial crisis in cases with fiscal space reaches a maximum of just 1.4%, and the fall in GDP in cases without fiscal space is more like 8%. And I think here the case that kind of exemplifies this effect is Italy following the 2008 crisis. So Italy began the 2008 crisis with a debt to GDP ratio of almost exactly 100%, just a tad more than a standard deviation above the average for the OECD. So fiscal space was quite limited. And here are two forecast errors for the episode. One is the forecast based primarily on lagged output, and one's from the forecast that includes the interaction with fiscal policy space. And what you can see is that the simple forecast error is large and negative. That's the blue line following the 2008 crisis. But when you account for Italy's lack of fiscal space, the forecast errors are roughly zero. Virtually all of Italy's large negative forecast errors in this episode go away when we take into account that Italy had little fiscal policy space, and low fiscal space is typically associated with worse outcomes. Now, the obvious extension to consider is to include interactions with both types of macro policy space. We've done monetary space separately, fiscal policy space separately. Now let's do them both together. And the results and the importance of policy space are slightly stronger for the two types of policy together than for each separately. And this figure is going to show you the behavior of output following a financial crisis when you have both types of policy space or when you're lacking both types of policy space. And I think the truly striking finding from this picture is just how small the negative aftermath of a financial crisis is when a country has both types of policy space. The fall in GDP is less than 1% and not significantly different from zero when you have both types of policy space. On the other hand, being without either type of space is associated with a truly terrible outcome, a fall in GDP of about 10%. Now, interestingly, in this specification, both interactions are substantial, but those for monetary policy space are smaller and only marginally significant, while those for fiscal policy space are large and strongly significant. So that could indicate that fiscal space is somewhat more important. Now, we do one last forecasting exercise in this part of the paper, right, to get a better sense in general of sort of the importance of policy space. So what we're going to do is look over the 19 episodes of high financial distress, and we're going to compare the forecast errors for a forecast based primarily on lagged output, and one that includes these interactions with both fiscal and monetary policy space. And what we find is that the variance of those forecast errors is about 30% smaller when we include the interaction effects. So this suggests that a significant fraction of the variation we observe in the aftermath of financial crises is explained by differences in the amount of policy space that countries have going into the crisis. Now, overall, the message of this part of the analysis is that the aftermath of financial crises is decidedly worse when countries lack monetary and fiscal policy space. Moreover, we can account for a substantial fraction of the variation we observe in the aftermath of crises with policy space. Or to put it bluntly, some crises are much less traumatic than others because policy is much more able to respond. Now, before looking more closely at the mechanisms through which policy space matters, I want to emphasize that this finding is at once both unsurprising and radical, right? So it's unsurprising because a vast number of empirical studies find that monetary and fiscal policy have important effects on economic activity. Thus, it's completely sensible that having more policy space should be correlated with less severe aftermaths of financial crises. The finding's nevertheless radical because much of the literature has stressed the inexorable negative effects of financial disruptions. And this has led many policymakers to think that the aftermath of financial crises is out of their hands. And I think our evidence strongly suggests that that simply isn't true. All right, so having shown you that macro policy space is important, the obvious question is why? What are the mechanisms by which policy space matters? Why is it that the aftermaths of crises are better when policymakers have room to maneuver? And the equally obvious potential answer is that policymakers may use policy more aggressively to respond to a crisis and the recessions that follow when they have policy space. And that's something we can test empirically. And to do that, we're going to run yet more of these panel regressions as we did before. But now, in place of having output as the variable we're looking at, we're actually going to look at the policy response, say a measure of monetary policy or a measure of fiscal policy. And we're going to see if that policy response varies with whether the country had monetary or fiscal policy space. So just so you know what we're doing, we're going to be regressing policy at various horizons after time t on distress at t and an interaction term between distress and prior policy space. And we're going to assume that monetary space matters for monetary policy response, fiscal space matters for the fiscal policy response. But what these regressions are going to tell us is whether the policy response to a crisis varies systematically with how much policy space you had going in. Okay, so let me start with the monetary policy response. We're going to use as our measure of monetary policy just the change in the interest rate that the central bank controls. We think a good indicator of what the central bank is trying to do is how it's moving this key policy interest rate. And the results are very supportive of the view that monetary policy is, perhaps not surprisingly, used much more forcefully when there is policy space. And the estimated coefficient, again, on that interaction term, it's now negative, right, and highly significant. And what that means is that a country with more monetary policy space cuts interest rates more in response to financial distress than a country without monetary policy space. Right? And this picture is going to show you sort of the size of the difference, right? So it shows the behavior of the policy interest rate following a crisis when there is and isn't monetary policy space. So when a country does have policy space, the policy rate falls about 2 percentage points, and a lot of that happens very quickly. When it doesn't have monetary policy space, the policy rate, again, not surprisingly, doesn't fall, and if anything, it rises slightly. Now, if you actually look at what happens to policy interest rates in episodes of acute financial distress, this difference is even more pronounced. In virtually all of those, it looks as though if that monetary policy responds strongly to a crisis if a country has monetary space, and essentially none at all if it doesn't. Right? So here are 2 cases where a country began its crisis with ample monetary space. One is the US in 1990, following our substantial financial troubles related to our savings and loan crisis. And the other is Finland, that had a crisis in 1993. And the red bars show you what happened to the policy interest rate, that interest rate that central banks control. And what you see is that going into both of them, they had lots of room to cut interest rates, and they took advantage of it. In response to financial distress, interest rates fell, at least 5 percentage points. Right? Here are 2 cases of countries that started their financial crisis without monetary policy space. So the first is Japan in 1997. You can almost see, right, we're again graphing with those red bars, the policy interest rate. When distress became acute in 1997, interest rates were already at zero in Japan, so not surprisingly, they weren't able to cut them. Likewise, I drew a picture here of Portugal following the global financial crisis in 2008. And Portugal and a lot of the southern European countries were unlucky enough to have sort of their spike in financial distress occurring a little later, after the European Central Bank had already brought interest rates pretty close to zero. So even though financial distress stayed quite high in Portugal, there was no place for interest rates to go down. All right, so that's what happens to monetary policy. Now let me talk about fiscal policy and the response of fiscal policy to financial distress when countries do and don't have fiscal policy space. Now, fiscal policy data, I've got to tell you, are a challenge. An obvious measure of fiscal policy, I said it has to do with the government budget, so you might look at just the change in the government's budget surplus. But this measure, as economists will tell you, can be very deceiving, right? The budget surplus naturally tends to fall when there's a recession because tax revenues decline when unemployment goes up. So a better measure of what policymakers are trying to do is the change in the high employment surplus, which just is the budget surplus that would exist under normal economic conditions. Now, because official data on the high employment surplus don't exist, for this paper we had to try to construct our own rough estimate using data on GDP growth and the usual sensitivity of the budget to the state of the economy. Right, but we're going to run very similar regressions now to the ones we did for monetary policy, but now we're going to look at the response of that high employment surplus to financial distress, and we're going to include that interaction term to see if we use the fiscal policy more when there's fiscal policy space. And the results are just remarkably clear-cut. So again, that coefficient on the interaction term, which is how you really see if there's an effect there, is highly statistically significant, and it's strongly negative. So a country cuts its high employment surplus more when it has fiscal policy space in response to a crisis. Right? And this picture is going to show you the difference in the response. Right? So this is showing you what happens to the high employment surplus in a country with fiscal policy space, that's the red line, and without. And what you're supposed to notice is a country with fiscal policy space that starts with a relatively low debt to GDP ratio, confronted with a crisis, they cut their budget surplus a lot. They engage in substantial fiscal stimulus, and that's about 4% of GDP. So the effect is large and very important. On the other hand, countries that begin their episode of financial distress without fiscal space, with a relatively high debt to GDP ratio, not only do they not cut their budget surplus, they actually go in the wrong direction, right? They engage in substantial fiscal contraction. And again, the numbers are about 3 to 4% of GDP, right? Now, if you think about the history of countries with high debt facing a financial crisis, this difference should not be as surprising as it may seem. Countries that start a crisis with high debt are often forced into fiscal consolidations after a financial crisis because deteriorating conditions swell their actual deficits and investor nervousness makes it hard for them to borrow. But I think this difference in the fiscal policy response could go a long way to explaining why countries without fiscal policy space have so much worse outcomes than countries with space. Now, if you look at what happens to the high employment surplus in key episodes, these findings are very much borne out. Right? So this picture is going to show you 2 cases of countries that started their financial crisis with a relatively low debt to GDP ratio. Norway back in the early 1990s, and the UK in 2008. In both cases, they were about 1 standard deviation below the sample average when the crisis started. What you're supposed to notice is that both countries that had fiscal policy space when they had a crisis used it, right? They cut their high employment surplus. They engaged in fiscal expansion. Now I'm going to show you two countries that started their crises without fiscal space, with a relatively high debt to GDP ratio. One's Japan in 1997, and the other is Italy in 2008. And again, you see just a fundamental difference. These countries, in the blue line, in case you haven't been figuring it out, that's our measure of financial distress. It's just showing you that they were having a crisis. What you're supposed to notice is in these episodes, the countries absolutely engage in fiscal consolidations. They actually cut their high employment surplus. They increase their high employment surplus so that they are raising taxes or cutting government spending. Now, not surprisingly, what do you suppose is the most extreme example of this pattern? It's Greece in recent years. So Greece began its period of extreme financial distress with a debt to GDP ratio of 109%. And if you look at what's happened to its high employment surplus, they ran expansionary fiscal policy for maybe a half year when the crisis first hit, but then have been engaging in just massive fiscal consolidation. Now, obviously this was not a choice, right? This was imposed on them as a condition for the IMF Euro area bailout. But I think overall what these results suggest is that a key mechanism by which policy space likely influences the aftermath of crises is through the policy response. Now, a possibly related mechanism actually has to do with the nature of financial distress itself, right? Perhaps financial distress disappears more quickly when there is policy space than when there isn't, right? It could be that policy space allows for policy, which stabilizes output, and restoring growth helps to heal the financial system. A more direct role could be that fiscal policy space allows countries to bail out their financial systems and so reduce distress that way. Or monetary policy space allows the central bank to just flood the financial system with liquidity more easily and so lower distress that way. Finally, perhaps just the mere existence of policy space is good for confidence. Maybe distress doesn't mushroom because people know that the government can intervene if necessary. Well, to look at this linkage, we're going to run one last set of these interaction regressions, but this time we're going to look at the behavior of financial distress in response to itself, in response to a crisis. So we're going to regress financial distress at various horizons after time t on financial distress at t, and we're going to include this interaction between both monetary and fiscal policy space and distress. And what this can show us is whether financial distress following a crisis when there is and is not policy space, that can show you whether the policy space makes distress less persistent. And we find strong evidence that it does. Right? So here's the last picture like this. I want to think about an impulse to distress of 7. And what you're going to look at is how over time, half years after time t, how does financial distress evolve over time? And the blue line shows when you don't have policy space, and the red line shows when you do. And what you're supposed to see is when you don't have policy space, the distress lingers. It, in fact, stays basically the same for the first half year and goes down very gradually. Whereas the red line shows you when you do have policy space, the financial distress goes away much more quickly. And so if you look, say, 2 or 3 years out, there's a very large difference between how much distress has disappeared following an impulse. And actually, if we look at some key episodes, this link between policy space and the persistence of distress, I think, is pretty clear. So here are 2 cases, Sweden and Iceland. In both cases, the countries started their financial distress with both a lot of room to cut interest rates and a pretty low debt to GDP ratio. So they had both types of space. What you're supposed to notice, Sweden's the classic example. Distress shoots up, goes away almost instantaneously. Iceland is in some ways, right, distress obviously lasted quite a while, but what's striking about Iceland is they had terrible distress, right? It's one of the highest overall levels of distress in our whole sample. And notice it comes down, starting at a very high point, comes down pretty quickly. Let me contrast this with two cases where the countries started their financial distress without either type of policy space. So Japan in 97 and Italy again. Notice what happens. Japan, distress goes up, it starts to resolve some, but then it goes back up, right? They weren't able to actually deal with the problem. Likewise, Italy, it has financial distress. It wasn't terribly high, but it just doesn't go away. It just lingers. And that same picture kind of shows for all of the southern European countries. Right? So I think the bottom line of this analysis is that policy space appears to affect the aftermath of financial crises through various mechanisms. It's correlated both with a more aggressive policy response and with less persistent financial distress. And both these things are likely to be associated with less severe post-crisis downturns. All right, well, let me conclude with just a little bit of reminiscence. So Barack Obama was elected president in November 2008, just weeks after the collapse of Lehman Brothers and smack in the middle of the global financial crisis. And I came on as one of his economic advisors just shortly after the election. And I can imagine no greater honor than having served in his administration at such a pivotal time. But I will be honest that it was, frankly, terrifying. Month after month, we just got dreadful reports on the state of the economy. The United States lost more than 4 million jobs just between September of 2008, when Lehman went under, and March of 2009. And the president was desperately trying to right the economy, and his economics team was desperately trying to advise him. But we were in largely uncharted territory, and we simply didn't know what the best policy was. And when the economy finally started to stabilize, I can tell you that we were all greatly relieved, the president most of all. And I remember vividly the first time we got just a bit of positive news. So it was the employment report from November of 2009. And when the numbers came across my desk, the job loss, there was still some job loss, but it was much smaller than anyone had been expecting. It looked as if the tide was starting to turn. And so I ran over to the Oval Office to give the president the news, and I exclaimed, "We only lost 11,000 jobs." And you would have thought I had given him the best news ever. So I literally got 4 hugs and a kiss, right? I think what the bottom line of the research that I've been describing today is that countries ought to be able to do better in the future. What our research shows is that a financial crisis does not have to be a death blow to the economy. There's tremendous variation in the aftermaths of crises. More importantly, macroeconomic policy appears to play a large role in explaining why some countries weather crises remarkably well, while others suffer greatly. This means that policymakers can, to a large degree, control their country's fate. But I think our particular findings may suggest policy prescriptions that are somewhat hard for policymakers to follow. So for example, right, our finding that starting a crisis with monetary and fiscal space is associated with better outcomes suggests the need for some difficult decisions in non-crisis periods. So for example, in order to have fiscal space when a crisis hits, policymakers are going to need to eschew persistent budget deficits and maintain a relatively low debt to GDP ratio in normal times. That is, fiscal policy needs to be highly responsible in good times. Perhaps counterintuitively, monetary policymakers may need to be a little less responsible in normal times. If you think about it, low inflation means that nominal interest rates tend to be low, so monetary space is inherently limited. But if you have a somewhat higher target rate of inflation, you might find that on average your interest rates, your policy interest rates are a little bit higher. And so that means that policymakers can be sure of having some more space to cut interest rates in response to a financial crisis or other shock. Now, both these policy prescriptions may be difficult to follow. Few countries have the stomach for truly responsible fiscal policy in good times, and few central bankers seem to have the stomach for even slightly higher normal inflation. Furthermore, our finding that policy space matters substantially through the degree to which policy is used during the crisis also implies some difficult decisions. For example, it's not enough to have ample fiscal space at the start of the crisis. Policymakers also have to actually use aggressive fiscal expansion. However, despite what I think is overwhelming empirical evidence that fiscal stimulus is effective in counteracting the negative effects of a financial crisis, the issue has become just such an ideological dividing line in the United States and much of Europe that I fear that policymakers might refuse to use it the next time a country faces a crisis. So where I end up, I guess, is not a particularly optimistic place. On the one hand, our research shows that policy can and has played a vital role in explaining why some aftermaths of crises are so much better than others. But policymakers need to be willing to take the actions before and during crises that could actually ensure that no time is very bad. And that could be a much bigger challenge. Thank you.
Christina, thank you so much. As my brother asks when he tells a joke, is this thing on?
Yes.
Is it? Oh, it is? All right, okay, sorry. We're going to take 20 minutes for Q&A. That's slightly shorter than usual, but we were a wee bit late starting, and I know what it can be like being behind a group of people and a drinks reception. But let me mention a couple of things. David Romer is going to join us for the Q&A. We're not actually going to do that, but I do want to assure you that David is alive and well and here in the audience and will be joining us for drinks. We just thought we'd keep it a wee bit simpler. I'm going to take questions a couple at a time. I'd suggest if you would like to ask a question, go early, because often you'll find that, towards the end of the period is when you get the forest of hands and a lot of disappointment, the kind that can only be drowned in a glass of wine. And the economists in the audience, when you're considering how technical to be in your questions, please be sensitive that we also have a lot of non-economists in the audience. So who would like to start? Please tell us who you are and be relatively brief. And in fact, there's one right down the very front here. So if you wait for the microphone, because we're recording, and it's a long library, and we don't want to make her run. Thank you. And then a second one here in the...
It's John Moore again, sorry. Is it the space or the policy which does the good work? Perhaps you said this and I didn't catch it. I was wondering if, for example, if there was a country which had the space, didn't use it, and the results were bad.
I will take the second one in the middle, behind you on your left, if you turn around. Yes, the gentleman could put his hand up again, that would be great, thank you.
My name is Gene Tidrick. I'm a retired economist, formerly with the World Bank. I believe I'm right in saying that in the argument about the US response to the crisis, you calculated that the fiscal response that was needed for the US to recover properly was about twice what was actually enacted. And the argument went that, well, we could always do more later, and the political economy of that, of course, didn't work out. I was wondering if you could speculate on what the difference would have been if the US had actually had a more substantial fiscal response. And I also would like to know if you think that Kenneth Rogoff's famous paper, which turned out to be based on mistaken data, showing that there was some magical limit of 90% debt to GDP ratio, which was a critical threshold, actually stopped a lot of countries, including, of course, the UK, from doing what it might have done better on fiscal policy.
All right, we're going to, that already is a few questions. So first in response to John. So it's hard to say, is it the policy response or the policy space? Because as I mentioned before, you'd expect a country that was doing really badly to use policy more. So it's going to be hard to find that link. But I think our evidence is very much consistent with that story. So the policy space is the thing we can definitely see the outcomes are better when you have space. And the other thing we find is you do use policy more when you have space. So I think those two things together suggest that it's largely because you use the policy that makes space matter. That's not the only thing, because I can well imagine that there are other things like confidence effects, that if you have space, then things are less likely to get out of control. We do have the fact that distress itself resolves more quickly. That could be because you used your policy, or it could just be people don't panic as much because they know they have space. So, but I think the policy response is a big part of it. All right, so coming back to the questions about the US fiscal response in 2009, you were right that I was certainly on the side of pushing for a bigger fiscal response. But part of that, I mean, I mentioned that we were somewhat in uncharted territory, and at the time we were trying to guess what the effects of a financial crisis were going to be, trying to have some sense. I can remember these long discussions between, would this be something that mainly was felt in the United States and the UK, where the crisis kind of started, and would maybe the rest of the world hold us up, or would we all go down together? And so back in December and January of that start of the Obama administration, we didn't know which way it was going to go. And then we started getting this horrible data saying that in fact the rest of the world was coming down with us, not holding us up. I will speculate that if we had done more, I think we would have healed much more quickly. I think there's just a lot of evidence. In fact, one of the small, silver lining of the crisis is we now, I think, have much better evidence on the effects of fiscal policy, because we've been able to use the fact that countries did different policies, or even within the United States, we had different amount of fiscal stimulus in different states. And all that evidence is suggesting that fiscal stimulus absolutely does work. And so if we'd done more, I feel quite confident we would have healed more quickly. An interesting kind of relationship here is, I think the United States may be an example that fits some of what David and I are finding. So why were we able to do a pretty big fiscal stimulus? So we did do $800 billion, which was substantial. And we were able to do that because we started the crisis, certainly not with a particularly high debt to GDP ratio. Part of what happened in late 2009, when it was clear we needed more fiscal stimulus, is the world, and especially US policymakers, were panicking. Our debt to GDP ratio was up, and they were afraid to do more. So I think that's maybe a classic example. If we'd started this episode with a debt to GDP ratio down at 40% rather than at 60%, maybe people would have allowed us to do more fiscal stimulus. And then finally, just on the 90%, I mean, one of the things, so for those of you not up on this literature, Rogoff has argued that, when countries, 90% like that crucial level debt to GDP ratio, where if you try to go above that, markets lose faith in you, and it's hard for you to do that. And I think what our numbers show, we've actually tried to see if there's some magic cutoff. We find it's basically a linear relationship, that the higher your debt to GDP ratio, the more constrained you are, the lower it is, the less constrained you are, and there's not some tipping point. But I do think, in general, our finding is that as it gets higher, countries are either less able or less willing to use fiscal policy. And so I think that is a problem.
Thank you. So there's a gentleman here on the right, halfway down, and have we another? And then, yes, behind. Thank you.
Thank you. I'm Jeremy Peat, formerly director of the Institute. Thank you very much for a fascinating talk. I noted that one particular problem example was Japan, because it had basically two episodes of distress, one after the other, and it had used up its fiscal space, its policy space, if you like, in dealing with the first episode. Most of the other cases you looked at were fairly well spaced out distress. So I wonder whether, if we were to be having more frequent periods of stress going forward, whether countries that had used up their space first time round, like, say, the UK in 2008, might face particular problems if there were to be another case of severe distress, for example, following departure from the European Union. I just wonder whether that issue of recurring distress periods is one that may feature more in the future.
Behind you on your right.
Simon Clark from the School of Economics. You talked about fiscal policy and monetary policy, but you might also want to think about financial policy, which, the Bank of England has a financial policy committee. It's not clear what policy space would be for financial policy, but it clearly is potentially at least an important policy instrument.
I have this, so we're good. Let's see, so on Japan, so Japan's a little bit of a hard case because, as I described, they basically have 15 years of some distress, but you're right, there are definitely two peaks, one in 1997 and another in 2002. And I think to the degree, I think even, the 1997 episode, they already didn't have much space, right? They were already down to almost zero on interest rates, and they've traditionally had a pretty high debt to GDP ratio. But I think you are definitely onto something, which is that if these were to become, because definitely financial crises, especially because they cause recessions, or if you take fiscal actions to deal with them, they do tend to raise your debt to GDP ratio. So if the next one comes quickly, that's going to be more of a problem. And it does come back to what I said was this difficult sort of policy, what you need to do in normal times, right? So I think, right, I'm most known for being a proponent of aggressive fiscal expansion during the crisis. It's a little bit of a strange turnaround, but I'm also quite a deficit hawk. And I think it's precisely because in normal times you need to be getting your budget deficit under control, precisely because I want to be able to use a really big fiscal stimulus if you need it. And so I think that is the way countries, I think, are going to need to deal with this, is to, we currently have this system where we just don't tend to deal with our budget deficits, right? So the debt to GDP ratio gets high, and then we don't do the hard things of getting it down. And so when I think, say, about the United States, I'm apoplectic at the idea that now that our unemployment rate's down to 5%, this is the time when we ought to be dealing with our long-run budget problem, dealing with the fact that the baby boom generation is retiring, dealing with rising healthcare costs. And instead, what are we talking about? We're talking about a huge fiscal expansion in terms of a big tax cut, right? And that is, I think, exactly the wrong policy if you want to be in a position the next time a crisis comes to be able to deal with it. On the point about financial policy, yes, I think we are coming to realize that we have a range of tools. So I understand conventional monetary and fiscal policy. I think where you were getting is exactly financial policy is a little bit less clear, but certainly in terms of, you know, taking actions to try to nip financial distress in the bud, or to prevent the sort of the buildup of speculative bubbles that can lead to financial distress. I think that absolutely needs to be on the table. And I think the other place we need to be more creative is to think about, you know, if we're not going to be able to, say, move to a slightly higher inflation target, so we're going to have more conventional monetary policy, we certainly need to be thinking about, well, what are our other tools? Are there, you know, I was very interested in the Bank of England's funding for lending scheme, right? Can we actually think of ways to encourage lending that aren't just, can we reduce the policy interest rate? And I think that is a place where research and policy needs to go.
Thank you. So there's a gentleman here halfway down on the left. Yep. There was another gentleman, I think, yes, just in front of him. So if you could pass the microphone on when you're ready. And then I'll take another couple. And so this lady down here and then this gentleman here. Thank you.
Thank you. Bill Roger, European Movement in Scotland. And long ago studied economics. It's moved on. I was very struck by your initial graph that showed the production drop-off before the two financial panics coming fairly close together in the early 30s, and then the subsequent one. And it made me wonder a little bit about how the interrelationship between the financial sector, the financial and the so-called real economy, and I wondered if, to some extent, we overstate the dependency of the real economy on the financial sector. But the other side of that is how you then put the fiscal and monetary measures into place, and whether you've been able to look at or intend looking at the different ways in which you might do that, how you might provide the stimulus through direct capital spending, for example, or as opposed to quantitative easing and pushing it through the banks, or basically helicopter money to the guy in the street.
Thank you.
Hello, Martin Fairbairn from the Scottish Further and Higher Education Funding Council. I'll admit to not being an economist. That breaks the trend a wee bit here. Quite simply, I'm wondering your thoughts in terms of policy space. To what extent is that a perception in economies? Or to put it more simply, are there any examples of countries that essentially have bucked the perception that they don't have policy space and been able to do that and have had a successful economic outcome?
All right, so these questions are just fantastic. So first on the 1930s, I think where you were getting is the really important idea, right? Financial distress doesn't come out of nowhere. Oftentimes, financial distress is the result of the economies going down. That causes loans to start to go bad, and that starts to be where some of these panics are coming. And I couldn't agree more that the experience of the United States in the early 1930s, right, we had a dramatic drop of output in late 1929, early 1930, and I think that's a big part of why we had that first wave of banking panics. So I think this link between the real and the financial economy, we have done a lot of thinking about the effect of the real economy or the effect of financial crises on the real economy, but we ought to also be thinking the effect of what's going on in the economy on the financial sector, and absolutely that's the case. On your question about putting, what can we put in place, in terms of, what are some of these policies? As I said, I think we definitely need research to figure out Is there something that monetary authorities can do, when they run out of conventional monetary space? We've seen quantitative easing. We've seen trying to have slightly negative interest rates. Where do we go from there? I think it's important if we're going to keep hitting the zero lower bound, which, as I suspect we are, both because we'll continue having crises and because inflation's very low and because real interest rates seem to be very low. We need to be thinking now about how to deal with that. I've thought more about the fiscal side, so I will admit, one of the things that frustrated the president, frustrated me, when we think back to Roosevelt in the 1930s, right, he managed to do public works, right? So the government directly hiring people. And there is one winter when, it looked like people were going to freeze and starve, and they hired 4 million people in a very short period. And I had the experience, we were trying to think of a public employment kind of scheme for the United States, and I literally called every cabinet secretary and said, if money were no object, how many people could you hire? And a typical answer was, oh, tons, 20, 30,000. And I'm sitting here going, we have lost 8 million jobs, 20 or 30,000 is not going to do anything. So I would love as a research program, to think about what's a kind of direct public employment that you could do quickly, and whether it's short time like they did in Germany, or the government hires people to do, useful maintenance on something, but I think that's a really important one. On the question, again, I thought was just fabulous. So we've said, what's the role of policy space? And we have found a statistical relationship between if you have a high debt to GDP ratio or you're at the zero lower bound on interest rates, you tend not to use policy. Now, on the zero lower bound on interest rates, or you tend to have worse aftermath of crises, and you tend not to use policy. On the lower bound on interest rates, you can see that might be a binding constraint. You can't cut interest rates very much if you're already at zero. On the fiscal side, we didn't know what we'd find, right? You might think, you're a country like Italy, you run deficits all the time, so why not in the middle of a crisis? Why wouldn't you run a big deficit? And so is it that having a high debt to GDP ratio really does limit your ability? So people won't lend to you, you get into trouble, and you have to have some sort of a bailout from the IMF? Or is it just policymakers sort of internalize that? And certainly I think the United States, there was never a question of could we still borrow? I mean, we were borrowing, the world was happy to lend to us at basically a zero interest rate. So the US government could have borrowed and done more fiscal expansion in late 2009. But policymakers definitely seem to have felt constrained, and whether that was real, whether that was just political posturing, but it seemed to have been the way they were acting. So I think that mental constraint may be as much as the market constraint.
Thank you. So there's a lady here who put her hand up. And then I'll take last two questions after this. So, and then I'm going to hand over to Sir John Elvidge, our chair of our Board of Trustees, for a vote of thanks. Thank you.
Julia Darby from the University of Strathclyde. You mentioned that fiscal policy varied in states within the US, but if you look at various countries where there's less variation, you still have quite big differences within the countries on a regional basis. So if you look at local authority data across the UK, or even within Scotland, you see quite big differences in depths of recession and the speed of recovery. So if we're thinking beyond space, are there other legacy things of what was happening before the crisis that you could add in here that the regional data might give you a handle on or give you some instinct on?
Oh, the gentleman behind you.
Arnav Bhattacharjee, head at Ford University Economics. Fascinating talk and fascinating conference all around today. My question is about normal times when policy is more difficult, arguably. So if we need to maintain policy space, is this policy space suboptimal for normal times? And then if, crisis periods are sort of rare in post-war economies, what kind of policy space would be optimal then?
All right. So actually, let me just start with the second question, because it's a great one. So I said one, right? So if you wanted to make sure you had room to cut interest rates, what that might say is, if you think the real interest rate is typically, say, 2%, if you have a 2% inflation target, then your policy interest rate is kind of normally about 4%. So you've got 4 percentage points that you could cut. If you had normal inflation of 4%, then with a 2% real rate, you'd have a normal policy rate of around 6. So you'd have 6 percentage points that you could cut, right? So that would be, you could get yourself more space. But exactly where your question comes in is, but the cost of that is you'd be running higher normal inflation. And so does that have cost? Does that make people unhappy? And exactly you're balancing these things off. I think on the fiscal side, I'm kind of less bothered by that, because it seems to me on the fiscal side, to the degree that you want to run budget deficits, it should be in response to unusual things, right? So you would want to, within, dealing with population growth or whatever, but a basically balanced budget over time is kind of what's going to happen eventually. And so a country like the United States, where we're projecting these huge budget deficits going forward, there's kind of no benefit to us to do that year after year. And so I'd much rather that we dealt with our long-run fiscal problem, got our budget deficit under control, and so then we can, have the space to intervene in things. So I think that's a case where there's not a countervailing cost that I can see, obviously. In terms of the cross-state evidence, so you're absolutely right that states differ, or regions within countries differed in how the crisis affected them. And in fact, one of the things that, and I mentioned sort of some of the interesting evidence, what's a fun fact about the United States, right? So if you're designing your fiscal stimulus well, exactly what you'd try to do is to give more money to places that are hurting more. And so you can imagine that would make it really hard to ever find these effects, because you'd say, well, I gave these places more because they were in more trouble, and look, they were in more trouble, so it looks like fiscal stimulus doesn't work. And so what the studies that have actually found how important fiscal stimulus rely on is the somewhat random allocation of spending. So it just turned out in our Recovery Act, some of our spending we didn't target to where there was more trouble. So like we just allocated the transportation money by how many miles of highway did you have. And so that meant that a state like Nebraska, that wasn't really in much trouble, got a lot of money because it's a big state with lots of roads. And so you actually can use this kind of random spending to say, you never want to explain this to Congress, but in fact, for an economist, it's wonderful because you can kind of randomly give states different amounts, and you can see, yes, the states that got more for these random reasons did better. But that comes back to, we should never lose sight of the fact that, right, absolutely the pain of any recession, but especially after the global financial crisis, was very concentrated in certain areas. And good fiscal stimulus will target them more so that you help the people that are suffering most. That's why thinking about things like direct public employment, or what are the things that really would help the places that are hurting the most, I think are important. But I think you're also pointing out, and again, I come back to the United States, of there's a lot of pain even before the global financial crisis that we weren't paying enough attention to, whether it's the decline in manufacturing, our Rust Belt states, all of the areas that are more hurt by trade. And I think the real challenge for economics and policymakers going forward is to say, how do you make people that felt like the economy is no longer working for them, how do you make it work for them so that they have a happier life and they're more feeling much better about their country. And I think that is absolutely the key challenge that we're going to face going forward, and what we should be thinking about.
Oops. I hate to bring this to an end, but the clock is against us, the wine is waiting, and there's not hands in the air, and so I'm going to ask Sir John Elbridge to give a vote of thanks.
Thank you. My primary thanks are, of course, to Christina Romer. It's a rare privilege to have the benefit both of such deep academic expertise and experience in government at such a critical and relevant period. And we have been hugely privileged to share in the way that you've been able to bring those things together. We've been privileged too to be given the benefit of the rigour with which you've presented the evidence and the arguments for your positions. And speaking for the non-economists in the room, we've been privileged to be given the benefit of the doubt as to whether we can follow the arguments that you've presented to us, and sharing an understanding of the analysis. And at a purely personal level, I add my thanks for validating two propositions that are important to me. One, that sound public finances in the good times is a matter of considerable importance, and two, that governments can actually do something useful during the bad times. Can I also thank MacCaLM as our hosts and partners in this event? Thank John Moore, thank Dr. Robert Zymek, the director of MacCaLM, and thank to Fiona Ross, the engagement manager for MacCaLM, who has been an absolutely invaluable help to us in working together to bring the event together. And finally, two brief commercials from a DHI perspective. We have a brand new website, and I encourage you to look at it. And for the students in the room, I encourage you to look at the website for the advantageous treatment that we offer to students in engaging with us. And secondly, can I simply repeat Jane France's invitation to join us for a drink now. Thank you very much, and thank you again, Christina.